The Dutch Tulip Mania, 1637. In the early 1600s, the Netherlands was one of Europe's most prosperous regions, with bustling trade and booming markets. Amidst this golden age, tulips, newly imported from the Ottoman Empire, captured the fascination of Dutch society. Initially, tulips were a luxury item, highly valued by the elite for their vivid colors and rare varieties. But as demand grew, people from all classes saw tulip bulbs as a potential investment, fueling what would become history's first documented speculative bubble. By 1636, ordinary citizens, artisans, and even farmers began investing heavily in tulips, some taking out loans or selling their assets to participate. Tulip prices reached astronomical levels. Certain rare bulbs were valued at more than a skilled artisan's annual income. In early 1637, however, the market reached a breaking point. Buyers became scarce and prices plummeted overnight, leaving investors with worthless bulbs and mountains of debt. Though the Dutch economy survived, the crash served as a lasting warning about the dangers of speculation, a theme that would echo through future financial history. The South Sea Bubble, 1720. About a century after Tulip Mania, Europe experienced another massive speculative bubble with the British South Sea Company. Established in 1711, the South Sea Company promised vast profits from trade in South America. The British government, looking to reduce national debt, backed the company, granting it a monopoly over this trade and allowing it to convert national debt into shares, a move that sparked a buying frenzy among investors. By early 1720, however, it became clear that the company's ventures were far less profitable than advertised, and as confidence waned, the market imploded. Shares plummeted, leaving investors, including many British elites, in financial ruin. This crash underscored the risks of unchecked speculation and introduced the concept of governmental regulation to protect investors. The Mississippi Bubble, 1720. In the same year as the South Sea Bubble, France faced its own financial crisis with the Mississippi Bubble, led by economist John Law. Law convinced the French government to establish the Mississippi Company, which held the monopoly over trade in French territories in North America. Like the South Sea Company, the Mississippi Company promised vast riches from resources in the New World. The French government granted Law control over issuing banknotes, creating an early form of fiat currency to support the speculative boom. The Panic of 1792, United States. As the United States emerged as a new nation, it encountered one of its first major financial crises with the Panic of 1792. Treasury Secretary Alexander Hamilton had just established the Bank of the United States, hoping to stabilize and grow the young country's economy. Early financial markets in New York grew rapidly, driven by investments in government debt and speculation in bank stocks. Hamilton's policies led to a bullish market, with bank stocks soaring and speculative fever taking hold. In 1792, however, a group of investors led by speculator William Duer borrowed heavily to buy government debt, hoping to resell at higher prices. When their speculation went sour, Duer and his partners were forced to liquidate their holdings, sparking a wave of panic. Investors rushed to sell off assets, and banks experienced a sharp liquidity crunch, the Wall Street crash of 1929. The Wall Street crash of 1929, often referred to as Black Tuesday, marked the start of the Great Depression, a period of unprecedented economic hardship in the United States and across the globe. Throughout the 1920s, the U.S. experienced rapid industrial growth, and the stock market soared as investors poured money into shares, convinced that prosperity would continue indefinitely. People from all walks of life, even those with modest means, invested in stocks, often purchasing them on margin, meaning they borrowed money to buy more shares than they could afford. This margin buying created an inflated market where stock prices were far higher than the company's actual worth. The euphoria came to a crashing halt on October 29, 1929. Stock prices began to plummet, sparking panic among investors. As people scrambled to sell their shares, prices spiraled downward, erasing billions in wealth within days. Banks heavily invested in the stock market and in loans to investors also faced ruin. The crash wiped out savings, led to bank failures, and caused unemployment to skyrocket. By 1933, nearly 1 in 4 Americans was unemployed, and the economy had contracted by almost 30%. The Great Depression brought extreme poverty, homelessness, and hunger, and it was felt globally as other economies that traded with the U.S. also suffered severe recessions. The Wall Street crash taught a lasting lesson about the dangers of speculation and the importance of financial regulation. In response, the U.S. government implemented significant reforms under President Franklin D. Roosevelt's New Deal, establishing institutions like the Securities and Exchange Commission, SEC, to regulate the stock market and restore investor confidence. This crash left an indelible mark on economic policy, emphasizing the need for oversight to prevent unchecked speculation from devastating economies. The 1973 oil crisis. The 1973 oil crisis introduced a new kind of economic crash, tensions rather than speculative bubbles. In October 1973, during the Yom Kippur War between Israel and its neighboring Arab states, the Organization of Petroleum Exporting Countries, OPEC, imposed an oil embargo against nations that supported Israel, including the United States and Western Europe. Oil prices quadrupled within months, sending shockwaves through economies worldwide that depended heavily on inexpensive, readily available oil. The impact was immediate and severe. Fuel shortages led to long lines at gas stations, and governments introduced rationing and restrictions on energy use. The sudden spike in oil prices led to stagflation, a period of stagnant economic growth coupled with high inflation, unlike anything seen before. Industries reliant on oil, such as manufacturing and transportation, faced spiraling costs, resulting in layoffs and economic contractions. By the time the embargo ended in 1974, the crisis had caused a global recession, with rising unemployment and inflation crippling Western economies. The 1973 oil crisis demonstrated the vulnerability of economies to global supply chains and the dependence on key resources. It led to a renewed emphasis on energy conservation, diversification of energy sources, and an increased push for energy independence, particularly in the United States. The crisis also marked the beginning of fluctuating oil prices, which continue to impact global markets to this day, underscoring the interconnectedness of geopolitics and economic stability. The Latin American debt crisis, 1880s. The Latin American debt crisis of the 1880s was a stark reminder of the dangers of excessive borrowing. In the 1970s, many Latin American countries, encouraged by international banks flush with petrodollars, profits from the 1973 oil boom, took on substantial loans to finance development projects and industrial growth. Governments believed that high commodity prices would enable them to repay these loans easily. However, by the early 1980s, interest rates rose sharply and global commodity prices plummeted, leaving Latin American countries unable to service their debt. In 1982, Mexico announced it could no longer meet its debt obligations, and a wave of similar declarations followed from other countries across Latin America. The crisis caused widespread financial panic as countries defaulted on their loans, and the region entered a period of economic stagnation known as the Lost Decade. Governments were forced to adopt severe austerity measures, cutting public spending, which led to social unrest, higher unemployment, and widespread poverty. The Latin American debt crisis exposed the risks of high external debt and dependence on global commodity markets. It also led to structural reforms in Latin American economies and the involvement of the International Monetary Fund, IMF, in restructuring debt. This crisis marked a significant shift in economic policy in the region as countries began to move away from import substitution industrialization toward export-oriented models. The Japanese asset bubble, 1880s to 1990s. In the 1880s, Japan experienced an economic boom that would end in one of the most prolonged periods of economic stagnation in modern history. Following decades of rapid industrialization, Japan became a global economic powerhouse, with stock markets and real estate prices skyrocketing. Driven by easy credit and speculative investment, this asset bubble saw land values in Tokyo exceed those of entire countries. Investors and corporations borrowed heavily to invest in real estate and stocks, believing that prices would continue to rise. However, by the early 1990s, the bubble burst. The Japanese government, concerned about overheating, raised interest rates, leading to a rapid decline in real estate and stock prices. The resulting crash caused severe losses for banks, corporations, and individual investors. As asset values plunged, Japan faced a financial crisis that resulted in a lost decade of economic stagnation, where growth slowed to near zero and deflation became a persistent issue. The Japanese asset bubble highlighted the dangers of speculative investment fueled by easy credit and exposed vulnerabilities within the banking sector. In response, Japan's government and central bank implemented reforms, but recovery was slow and the period of stagnation became a cautionary tale for other economies facing similar bubbles. Japan's experience with the asset bubble and ensuing economic malaise underscored the importance of sound monetary policy and careful management of credit to avoid long-lasting economic damage. The Asian Financial Crisis, 1997. The Asian financial crisis of 1997 was a wake-up call for global markets, demonstrating how quickly financial turmoil could spread across borders in an interconnected world. In the early 1990s, several Southeast Asian economies, including Thailand, Indonesia, South Korea, and Malaysia, experienced rapid economic growth fueled by foreign investments, booming exports, and significant borrowing. This growth spurred a speculative bubble, particularly in real estate and stock markets, as investors poured money into these Asian tiger economies, convinced of their untouchable growth potential. However, this optimism masked a growing vulnerability. Many of these countries had accumulated massive foreign debt and maintained overvalued currencies pegged to the US dollar. In July 1997, Thailand's currency, the baht, collapsed as the government could no longer defend its peg to the dollar due to depleted foreign reserves. Panic ensued, and the financial turmoil quickly spread to other Asian economies. Investors withdrew capital en masse, stock markets plunged, and currencies depreciated sharply. Within months, Indonesia, South Korea, and Malaysia were in the throes of economic collapse, leading to severe recessions and skyrocketing unemployment. The crisis led to widespread poverty, social unrest, and in Indonesia, even political upheaval, as President Suharto's long-standing regime was toppled. The International Monetary Fund, IMF, stepped in with bailout packages, but these came with strict austerity measures that deepened economic pain in the short term. The Asian financial crisis highlighted the risks of short-term capital flows and excessive borrowing in foreign currencies. In the years that followed, many countries in Asia restructured their economies and built stronger financial safeguards, such as increasing foreign reserves and implementing stricter banking regulations. The dot-com bubble, 2000. The late 1990s were marked by excitement over the internet and technology companies, with many investors betting that tech startups would revolutionize the economy. The rise of the internet led to a surge of interest in dot-com companies as investors flocked to buy shares in technology firms, many of which had little or no profits. As venture capital poured into Silicon Valley, initial public offerings, IPOs of tech companies skyrocketed, and valuations for companies, even those with unproven business models, reached dizzying heights. By early 2000, however, the bubble burst. Investors began to realize that many dot-com companies lacked viable paths to profitability, and as confidence waned, stock prices of tech firms plummeted. Within months, the Nasdaq, a stock index heavily weighted with tech stocks, lost nearly 80% of its value, wiping out trillions in investor wealth. Countless dot-com companies went bankrupt, and Silicon Valley was left reeling. The aftermath of the dot-com bubble taught the market a harsh lesson about the risks of speculative investing and the importance of valuing companies based on fundamentals rather than hype. While some companies like Amazon and eBay managed to survive and eventually thrive, many others faded into obscurity. The bubble's burst also led to greater scrutiny in the tech sector, with investors becoming more cautious about placing their money in untested ventures. It served as a reminder that innovation, while exciting, does not always equate to immediate profit, and that market value should reflect actual business potential. The Global Financial Crisis, 2008. The 2008 global financial crisis stands as one of the most severe economic collapses since the Great Depression, with effects that reverberated around the world. During the early 2000s, the U.S. housing market was booming, fueled by easy access to credit, low interest rates, and an influx of new mortgage products that made it easier for people to buy homes. Banks and financial institutions, eager to capitalize on the housing market, began issuing risky subprime mortgages to borrowers with poor credit. These mortgages were then bundled into complex financial products known as mortgage-backed securities, MBS, and sold to investors worldwide, spreading exposure to the U.S. housing market. In 2007, housing prices began to decline and many subprime borrowers defaulted on their loans. As defaults increased, the value of mortgage-backed securities plummeted, and financial institutions holding these assets faced massive losses. By September 2008, Lehman Brothers, a major investment bank, filed for bankruptcy, sparking panic in global markets. Stock markets crashed, banks stopped lending to each other, and governments around the world were forced to intervene to stabilize the financial system. The crisis triggered a global recession, leading to millions of job losses, business closures, and widespread foreclosures. In response, governments implemented sweeping regulatory reforms, including the Dodd-Frank Act in the United States, aimed at increasing transparency and reducing the risk of future financial crises. The 2008 crash underscored the dangers of excessive risk-taking in the financial sector and highlighted the need for robust regulatory oversight to protect economies from systemic risks. The COVID-19 recession, 2020. The COVID-19 pandemic brought about an economic crisis unlike any in modern history, driven by a global health emergency rather than financial speculation or geopolitical tensions. As countries imposed lockdowns to contain the virus, entire industries, particularly tourism, hospitality, and retail, ground to a halt. Stock markets experienced a sharp drop in March 2020, and millions of people lost their jobs as businesses shut down or reduced operations. Governments worldwide responded with unprecedented stimulus measures, providing direct payments to citizens, expanding unemployment benefits, and supporting struggling businesses. Central banks lowered interest rates and implemented quantitative easing programs to inject liquidity into the economy. Despite these efforts, the global economy contracted sharply, and many countries entered deep recessions. The COVID-19 recession highlighted the vulnerability of global supply chains and the importance of economic resilience. It accelerated trends toward digitalization and remote work, reshaping the labor market and consumer behavior. The pandemic underscored the need for governments to be prepared for crises beyond financial markets and demonstrated the role of swift policy intervention in mitigating economic shocks. What are your thoughts on this? Let us know in the comments below. Don't forget to like and subscribe to the channel for the latest tech news. Thanks for sticking around, and I catch you in the next one.